You're listening to Brian Bushlach's Business Briefing on FM News 101.
Well, with the economy bouncing back, boomer business owners who delayed their exit strategy are now starting to look at this again. It's the right time to do it, and always we recommend you get an early jump on this. I sat down with our accounting expert, Michael Lortz at Geffen to get his take on business exit strategies for boomer business owners. Timing is so critical here, and I think that many of the business owners I've talked to over the past 5-6 years, maybe in the early to mid to late 60s, were planning that exit in 2005, 6, or 7, but didn't get in front of it enough before we had the meltdown 2008, 9, and into 10 before we started this comeback. So you look at these business cycles here, and I mean, really, we go through a recession at least once every decade of varying magnitude. So you really have to be well positioned, as you mentioned, 3 to 5 years in front of this to have a good sale.
No, that's absolutely right. And of course, I won't try to predict when the next recession is. But
come on, Michael.
But, we do find that there are various steps people can take to start planning now. As tax advisors, there's things that people can do from a tax standpoint to position themselves. There's also things they can do from an accounting standpoint, from a financial statement standpoint, to try to maximize value as well.
It's we can't stress this enough. You talked about the planning in advance of the sale, but there's so much that goes into it. And I think that most business owners get this, but we still have to say it that, really, if you're planning to sell your business, there is no cookie cutter way to do it. I mean, depending on the size of the company, the sector you're in, the timing and all that. But I mean, it really is at least a 2-year runway in advance of that, isn't it?
That would be ideal. And, just a couple of quick war stories. Over the past couple of years, I had 2 transactions come to mind that are on opposite ends of this spectrum. One transaction, we had about an 18-month runway where we knew we were going to have our client go out to market to sell their business. And we were able to do a lot of planning, a lot of structuring, so that at the end of the day, when the client sold their business, we paid capital gains tax rates on the entire sale. I would contrast that with another transaction where the client didn't want to incur any professional fees to plan for a sale. After all, what if the sale doesn't go through? Then it would have all been for naught. So we got involved when the client said, "Okay, I've got a signed letter of intent. Now tell me how to structure the transaction." And at that point, there's only so much you can do. And unfortunately, the vast majority of that sale resulted in ordinary income, which is taxed at a much higher rate than capital gains rates.
Yeah, you've got some remarkable numbers to share with us here. If you're just joining us on Business Briefing, Michael Lortz at Geffen here. We're talking about exit strategies for business owners, and I know more and more of you out there in our audience are starting to think about this as the economy improves. And let's talk about the planning itself. And these numbers are absolutely astonishing when you look at this. And you touched on it with that story, but let's delve into it a little further.
Sure. So, each business is structured differently. What we find is that there are some companies out there that are still organized as C corporations. That's what we call them from a tax perspective. And those companies tend to be some of the most challenging to structure a tax-efficient sale for. If you were to sell a C corporation business for $10 million, and if you were to do no planning, and if you weren't to structure it in a way that made sense from the standpoint of the seller, it's possible that you could walk away after taxes with about $3 million on a $10 million sale. It's staggering, and oftentimes when I tell people this, they gasp. And so that's really where there can be a lot of value added, is trying to make sure the business owner keeps a lot more of that sale in their pocket. Most of my clients come to me and say, I need to realize X dollars in order to have the retirement lifestyle that I want to have. And frankly, without good tax planning, you might have to grow your business a lot larger to hit that number.
I think when you factor that in, on the 10 million, the numbers on your slide, federal at 35%, Oregon, for those of you in Oregon, 7.6, Portland and Multnomah County, an additional 3.65% tax. Not to mention on a C Corp, you've got a dividend tax on top of it. I mean, I think that owners who are driving around right now, the region, hearing that go, how does 10 million become 3 point something? I mean, you do the math on that, it adds up quickly.
It does, and again, that just shows the power of planning, because frankly, the transaction doesn't have to work out that way, and good tax advice can make sure that it doesn't.
Michael Lortz at Geffen Mesher joining us. I'll give out his contact information in a bit, but this is an interesting slide here on the sale of a C Corp. With the proceeds totaling $3.960, this dividend tax, that can be avoided if you switch from a C Corp to an S Corp, correct?
One of the issues with C corporations that we talk about with our clients is this concept of double taxation. Where the corporation pays tax on gains, and then when the gains are paid out as a dividend, then the shareholders can pay tax as well. So it's possible to avoid that with a C corporation structure, but what a lot of companies do is they look at the possibility of making an S corporation election. It's a different type of tax entity, and it's not without its challenges, but if you can get there, and many times you can, if you can get there, then you can eliminate this double tax issue to a large extent.
Okay, so I guess in some cases, if you're set up as a C Corp, you can elect to be taxed as an S Corp, just as you can, I guess, in reverse with LLCs, correctly?
Yeah, that's right. So S corporation is a tax status, and so corporations can elect that status, LLCs can elect that status. There are tax ramifications for making that change. But I was speaking at a seminar recently, and after the seminar, one of the attendees came up to me and said, well, here's the type of business I have. Here's what my balance sheet looks like. I've never talked to my accountant about making this change to an S corporation. Is there any reason that I shouldn't make that change? And I said, obviously I'm just taking your word for what the situation is, but in that circumstance, you could convert to an S corporation and pay almost no tax on the conversion, and it could potentially save hundreds of thousands, if not more, dollars on an eventual sale.
Used to be the doctors who got dispense most of the free advice. Now it's CPAs. You get asked questions like this all the time, don't you?
Oh, we get popular during certain times of the year, particularly.
We'll have more in our next segment, Michael. Thanks.